I think it might be worth a brief pause to analyze why we're causing bleeds on our clients' brains.
We are supposed to have an investigative strategy, slow and steady, months, years even, to build a case.
People like Ashford want to sit in their pile and know that their money is working for them. If you lack impulse control, why are you managing other people's money?
Hi, my name's Alastair Matchett. I used to be a banker myself at J.P. Morgan, so I've been an analyst and been in these people's shoes. And I'm going to be doing a review of the first episode in Series 4 of Industry. It's the episode where Harper's got her own fund and there's a whole lot of shenanigans going on about her getting non-public material information and running shorts. So stay watching as I'll go through some of the key points and maybe give you some explainers of the jargon and the terms that are happening in the episode.
Anyway, he said he was going to make official contact, i.e. not boozy lunch contact, with our investor relations guy about withdrawing capital from your fund.
You're paid to outperform the market, not track it.
Roland, I fucking concur. So maybe you can tell me why it is I'm faced with a firing squad every time I try to put a short on.
I'm here to offer counsel.
I've not seen you offering counsel in anyone else's office. Is your counsel Otto's diktat?
Otto's retired.
I'm really tired of dancing around the fact that I was promised a fund and given what feels like a separately managed account with claustrophobic levels of oversight.
So here we can see that Harper has set up her own fund, and it's a fund that's orientated around shorting stocks. And what that means is you're taking a position and you profit if the stock's share price falls. But it does come with extra costs because you've got to pay things like dividends, and you also have something called margin calls. So when someone said putting a short on, what it means is that you borrow shares from your broker, which you can easily do, and then you immediately sell them at today's price. And you commit to being able to buying them back later, and you hope when you buy them back later, you're going to buy them back at a lower price. So this means if the price does fall, you're going to be able to buy back the shares cheaper, return them to the lender, and keep the difference. And you're going to have to pay some fees to do that and some interest. But ideally, your profit should be greater than the fees and interest. However, if the price rises, then you have to buy them back at a higher price and you make a loss. And the losses can be unlimited because price rises can be to infinity potentially. But it is risky. Here's a simple example. Imagine you've got a stock that's trading at $10 and you decide to put a short on, let's say 100 shares. So this means you borrow the shares from your broker, you don't pay for them, but then you will sell them immediately and you get $1,000 in from the sales. So you're sending some cash. Now, what will probably happen, the broker will also require you to put a deposit with them, which is called a margin. And that is some bit of protection in case the price rises. Now, let's assume that the price drops to $6. So this means then a week later, you buy back the 100 shares for $600 and return them to the broker that you borrowed them from. And that means, assuming no costs, that you made a profit of 1,000 minus 600, which is $400. And that's because you essentially sold them at $10 and bought them back at $6. Now, alternatively, the price had gone to $15, then buying back the shares would cost you $1,500. And that means you would have received $1,000, you would have had to buy them back at $1,500 and you'd lose $500 before costs. So there's some complications with shorting. And one of those is dividends. Because if the company pays a dividend while you're short, you have sold the shares, but you have also borrowed them from somebody. And the person you borrowed them from, your broker probably, will expect to receive that dividend. So this means that you're on the hook to pay the dividend to the broker. And that's an additional cost of shorting. Now, bear in mind, you do have the cash that you received when you sold the stock, so you can get a return on the cash, but things like dividends will cost you money, and you'll also be charged by the broker a fee for being able to borrow those shares, a fee for doing the trade, and then also some kind of interest as a kind of return for getting the shares from the broker. Now, the second complication is you have a margin account. And what that means is the broker will say to you, sure, we're going to lend you these shares, but we're worried that you may not be able to give them back to us. So what we're going to do is we're going to require you to make a deposit. And that deposit initially is called the margin. And that will be a percentage of the position. Now, if the stock price falls, that means potentially you will need less margin because you're in a profitable position, or you may probably not get any change in the margin, but it means you won't need to give them any more. Alternatively, if the share price rises and you're short, that means you're making a loss. And then the broker is going to get worried and they're going to say, hey, we had a margin of, let's say, 20%. We're going to ask you to increase your margin because we're more worried about you making a loss. So you're going to have to deposit more money at the broker. And that request is known as a margin call. Now, in the current situation, Harper's in a profitable position, so she's not going to have any margin calls. But that could change. So if the news changes, suddenly the position could flip into an unprofitable position, and then she also would have a margin call at that point. So ironically, in the very worst situation where the trade moves to a loss, you also have the costs of making a margin or completing a margin call request from your broker. So it's high risk, and you need to know what you're doing and be experienced.
This doesn't have anything to do with your chairman emeritus's political ambitions, does it?
What the fuck are you talking about?
Might be worth asking Lord Mostyn what a noisy, short-only fund was doing to his chances of a peerage when the Tories were defenestrated. The House of Lords Appointment Commission has a vetting process to ensure nobody brings it into disrepute. I have instructed my funds counsel to draft a redemption request and a note for your investor letters, if you're ever lucky enough to write another one again. There's no need to be so sesquipedalian.
Here we've got James coming in and shouting at Harper, saying that he's going to withdraw funds. Now, with hedge funds, they're normally withdrawal rules. And what that means is it's not like a stock where you can just sell with the click of a button. You need to give them notice, and usually an advance notice. And there's several tools that these managers can use to slow redemptions in times of stress. The exact terms will vary by the strategy, because some strategies are quite long term, so you will need probably much longer redemption rules for those funds. Other funds are kind of short term, so they have shorter term redemption rules. And it's also driven by the investor bargaining power between the hedge funds' power in terms of their presence in the market and funds under management versus the investors. So typically the redemption has a frequency. So this is typically quarterly, but sometimes it may be monthly or annual for very liquid strategies, long-term ones. And the illiquid strategies will be things like distressed debt investing, private credit. The notice periods that you need to give, usually 30 to 90 days, written notice before the date that you want to have redemption. In terms, most typically, that's 45 or 60 days is the most common features. And again, you need to do that for the next redemption date. So the redemption date, and then there's redemption notice. Now, when you first invest in the fund, usually there's an initial lockup, and typically it's a year. So new investors get a tougher terms. So once they've invested, they need to lock their money up for a year. Sometimes it can stretch to 2 to 3 years for illiquid strategies. Sometimes, so you can have what are known as like soft lockups. So you have the same kind of structure as I just mentioned, but for a fee, you can get early redemption. And that means that you can get your money early, but you're going to have to pay a fee for that. Hard lockups, where there's no exit at all, can be used, but it's pretty rare, and it really depends on negotiation. Now, in the program, they're talking about gates and suspensions. So usually what hedge funds will do is have what they call gate provisions. So on top of everything I've just described, they will also have caps in redemption. So for example, they will say no more than 10% or maybe 20% of fund assets can be redeemed in the period. And that's particularly implemented if withdrawal requests are unusually large, as in the case here. In some rare cases, you will have full suspensions, and that means like no one can redeem the money in the funds. But of course, this is used really sparingly, because like any investor, any fund, you're going to really upset investors. And if you do that once, they have memories like elephants, really, really long term. So that's pretty unusual. So in terms of just a kind of summary of the market standard terms, are usually redemption every quarter with between 45 to 60 days notice. And when you initially invest, you've got a 1-year lockup, and gating is invoked in a situation of stress, which is the case here. And then large institutional investors can negotiate better terms than this, where they have shorter lockups, investor level separate gating for them, or even customized side letters. So, but the basic framework is as I've described.
Bastos had a brain the size of a planet. He was an exceptional mentor, a real pintsman. Stickman too, but pintsman, that's where he made his name. If it wasn't his drinks to kill him, it would have been the cock rot. Drank like a Red Wall MP on expenses. A true proponent of clause 44 pints before 4 p.m.
What are we looking for?
It's my phone.
No? Where was it last?
I don't know, I think it was in here. What was it?
Fuck to find out.
Oh, cheers. Fuck me.
No.
Tastes like prison hooch that blinds you.
Oh, shots. Jeez. No, thank you. That is all you love.
Fuck.
Mate, you haven't seen my phone, have you?
I haven't.
So in this clip, we're seeing the guy trying to get inside information, and that is typically known today as material non-public information, or it's usually abbreviated to MNPI. And this is illegal to do, and it's actually not just illegal, it's criminally illegal. So if you trade on non-public inside information, you're essentially going to get put in jail. So this has happened in the hedge fund world in the past, and without mentioning names, traders have gone to prison for trading on this information. In fact, one of my ex-students was frog-marched out by the police from their desk. And I'm not going to mention their name, it wasn't the press, but this was a guy, and he had started to download all the M&A deals from the server late at night, like 3 a.m. And he then traded on that. In fact, he actually had a brother or friend who traded on it in another country. And the way they found him is that the IT guys were saying there's this real spike in activity around 3 a.m. and that's really weird. That shouldn't happen. So they did some research on it, and they kind of identified it coming from this one desktop user. And then they did some more investigation and realized that someone was downloading all this non-public information. And then they did some more research and found out that there was some suspicious trades on these names. And so then he was charged, put in prison, and he actually did time in prison for that. So this is completely illegal, and it shouldn't happen. So, and this is a kind of good story. It does happen, and you can see that Harper's actually handing over an envelope of cash. So if they get found out, this is a criminal offense, and they will both get into jail for this. So even the guy who's getting the information and Harper, who's trading on it, will both probably go to jail. There may, I guess you could do some kind of plea bargain, but it's a really big issue. And prior to the Big Bang in the UK, prior to 87, this kind of stuff wasn't illegal. So when people were trading, they were trading lots of this kind of non-public information, but that meant there was a real separation between the people who were kind of working in the industry and the investors on the outside. And it was a really kind of unfair playing field. And that's why they brought these criminal laws in, and they made them criminal to really focus people's mind about not doing it. So this is a storyline. It does happen. It's unusual, but they're at risk of going to jail because of this.
It's not compelling, but this can't be what you wanted to show me. I mean, this is a completely different business.
I canvassed our investors casually. They like the potential direction of travel.
Since when did this become a democracy?
Since we went public, we should be and can be a full-service banking app, a bank in your pocket.
A neobank.
Is that why you blew all this money moving us to Canary Wharf? The tab was probably smaller rebuilding Notre Dame. The euphemistic bull that spares everyone's blushes in our earnings reports, what's the phraseology?
Alternative merchants, 23% of income.
Alternative merchants, what does that mean?
Gambling and pornography.
Sucking, fucking, rolling the dice. PayPal, Google Pay won't touch it, so it's our 23%. Siren, which now dwarfs OnlyFans in terms of active users and profits, makes up, what, 4% of our revenue? Jerking off is recession-proof.
There are markets that aren't accessible to the project due to associations with Siren and other risque vendors. If Tender wants a banking license...
We can't expect people to want to deposit their savings or take a mortgage with us if we're associated with squirting videos and Ebony Gilf gets force-bred by Black Bull.
Fuck yeah. That's my go-to right there when I'm hungover.
So in this case, Tender is a payments company. Now, a payments company is a regulated entity. So in the UK, the FCA will require it to be registered, and they will have capital requirements, which means that there needs to be some capital deposited that is separated, and that is, if things go wrong, can be used to settle losses that people, users of the platform, have experienced as a consequence. So there is a regulated entity, and you'll need governance, you'll have anti-money laundering rules, and a robust tech platform. But the bar for a payments company will be really significantly lower than the bar for a banking license. And a banking license is required where you do something called taking deposits. And that means you're taking somebody's money, putting in a deposit and paying them interest, and then being able to use that money to then lend out to other people. And whenever you do that, take deposits, that means you will be regulated by the central bank typically. And in the UK, that will be the Bank of England. And the regulation there is separated into two parts. There's the prudential regulator, and they look at the safety or the safety of the bank's balance sheet primarily. Does the bank have enough headroom and cushion that if the loans contracted in value, there would be still enough money to pay the depositors in a very, very simple mechanism. So that's a prudential regulation, which essentially looks at the financial strength of the corporation or the bank. The second regulation is the FCA, which is the Financial Conduct Authority. And what they're looking at is the bank behaving in a way that benefits consumers. And you have those two pillars of regulation, actually in most countries now. But the ability to get a deposit taking license is much, much greater, much harder to get than, say, taking a payments company license. So this, as you can see, this is the big issue here. They're a payments company and they're doing some business with some fairly kind of dubious websites. If they're a bank, that would be much more difficult for them to do because you need to have a kind of a whole load of high regulation and much more stringent overview of the firm.
Haley, chair.
How'd it go?
Not good.
Now, this is a pretty despicable scene where Whitney is tossing a chair over because he's pissed off and then shouts to his assistant, come and pick up the chair almost immediately. Now, bad behavior does happen in investment banks. There can be some times of immense stress and it is unacceptable, but things do happen. And just in my experience, to kind of give you some context, there are two things that happened, and both on the trading floor. Doesn't always limit to the trading floor, but there was one trader, I think he was a French guy actually, and he worked in derivatives. And every time trade went bad or somebody traded against him, he would kind of stand up, take the phone after he'd received the bad news, stand up and put the phone on its end, or the handset on its end on the table, and then lean against it, and it would crack in half. And then he would just dump it on the desk and walk off. As that happened, the assistant pulls open a drawer full of these phone handsets, picked one up, takes the old phone, puts it in the bin, plugs in the new one, and goes and sits down. So that's one story where that's happened in a bank. The other story is where I saw somebody got some bad information, bad news, by email or something like that, and you could see him typing, and the typing got more and more stringent, and then started turning into fists, pummeling the keyboard, and the key started popping all over the place. And then he tossed the keyboard aside and then ran off the trading floor. So there's two examples. This bad behavior does happen. It's unacceptable. It's kind of funny to look at it in hindsight, but it's actually pretty disturbing when it happens in real case. And this is probably, a good example in the video of bad behavior, particularly as they get a subordinate to come and pick the chair up. That's kind of unacceptable, but it does happen.
Quibena, find me all the bar you can on Siren.
Now?
No, at the next full fucking moon. Yes, now.
Fucking hell, Harp, it's not very liquid.
All the size you can find.
Now in this clip, Quibena is talking about the stake not being very liquid. And what does actually liquidity mean? Well, when a trader says stock is illiquid, they mean it barely trades, or it's hard to sell without having a price move because you're doing a selling trade. So what does that actually mean in reality? Well, if the average trading value is under about 50 to 100,000 sterling, that means it's extremely thinly traded. And a lot of big investors will just avoid those stocks. And the reason for that is that when they start building a stake, that's great, they can build it up. But every time they do a buy trade, then the stock price will tick up. And the problem is getting out of that trade, because every time they do a sell trade, the stock price will tick downwards. And they won't be able to sell that position all at once, they'll be coming to dribble it out. And usually big investors will avoid anything that is below about £1 million in turnover, or where the bid-ask spread is more than, say, 2 to 5% wide. That's also an indication. If the bid-ask spread, which is the kind of buy-sell price, is wider than 2 to 5% of the underlying stock price, they'll probably avoid it, because that indicates it's an illiquid stock. So this is what Quibena means here, and he's worried that if they build this position, getting out of it's going to be really tough, because every time they do a sell trade, the stock will price and they will start to see their profits erode.
Okay, we're short, chunky for a mid cap, 100 bars, 3.2% of float.
So here Quibena is talking about 100 bars and a 3.2% of float. So what does that mean? Well, there's lots of different slang for the amounts within the trading industry, and they do change. But a bar is typically 1 million. So 1 bar would be 1 million, 100 bar would be 100 million. Now, given that the stock is illiquid, I'm kind of surprised that he's built a trading position of 100 million so quickly, because I would kind of expect there to be a cap of probably under 1 billion. So that's building a stake of about 10%. And you wouldn't be able to do that all at once. You'd need to do several trades and find investors who are willing to sell their stock. So I think that's a little unrealistic. Other terminology which is similar, so a grand or K is 1,000, which you probably understand. At the big end, a yard is 1 billion. Certainly in the London market, there was lots of terminology that related to kind of space in your back garden. So the whole thing, the yard is 1 billion. But in some desks you'd hear a patio, and a patio was 100,000, which of course is a small part of the yard. And then half a patio was 50 grand. And then 2 patios was 200 grand. So you had this kind of funny banter that almost is kind of Cockney slang in some cases in the trading world. But it's kind of fun speak, just in shorthand without ever having to say the numbers. Now the 3.2% that he mentions, what that means is 3.2% of the free float. And what free float means is all the stock that is available to trade. So it includes all the institutionally held shares and probably the retail shares as well. But it doesn't include the shares owned by the management team or the founders of the business, or if there's a charitable trust or any kind of other locked up stake.
Remind me what Siren was called before Balderton bankrolled your Series B and you hired that on-the-nose hip little agency for the rebrand? It had a military element, as I recall.
You partnered with Colonel Cream Pie.
With who?
With Colonel Cream Pie. You partnered with Colonel Cream Pie, and I want Jonah in this meeting. I want the chief executive here right now.
We'll start processing your payments in the next 24 hours. We'll then start cutting ties with other vendors in the space.
I'm sorry, but politely, we don't know you. So why are you in this meeting?
Now, Whitney in this case is talking about a Series B. What does that mean? Well, that is one of the funding rounds that you will see a startup company go through. Now, the best way of kind of understanding this is Series B is like secondary school. And if you go back one and you go to Series A, that is like primary school. And if you go back one before that, you get to what we call the seed round, which will be the equivalent of like kindergarten or nursery. And the seed round will be angel investors who are wealthy individuals or family and friends making investments into the company. And what happens is the seed round, you're kind of essentially proving concept. And then Series A is where you kind of have the concept, but you may need to maybe build out the technology or really start to build out a sales and marketing team, and you've kind of proven the concept. And then Series B is where the market is proven, you've probably got revenues, may not be profitable, but there's really distinct growth, but that growth needs investment to be able to unlock that growth. And that's what Series B. And then kind of university would be Series C, D, and maybe even like your master's secondary degree would be like when you do an IPO. And for large companies, sometimes you do a series of rounds. So you have A, B, C, D, E, etc. before you go into the public markets. Or maybe you don't even ever go into the public markets. And then you just have regular institutional funding rounds. So that's what they mean when they say Series B. It's part of the kind of funding rounds before an ultimate IPO that you may or may not do.
I get that.
Can you shut the fuck up, please, and just take the goddamn email?
Jesus Christ.
Issues with governance and management has meant I have not been able to fulfill the short-only mandate you believed you were investing in a little over a year ago. That changes from tomorrow. Yours, Harper Stern, Short Opportunities Fund, Mawson Asset Management.
Harper, look, I get you're the boss. This is not a good idea.
Send it.
Fine. What's the distribution?
Client-wide.
So in this clip, you're seeing Carmina and Harper in the bedroom. Harper is his boss. They've been sleeping together and she's dictating an email. Now, you may think, is this okay? Are you allowed to do this? Is sleeping with colleagues banned? Well, certainly there's a major issue here is a conflict of interest because she's his boss and she's in a more powerful position than he is. Now, having a relationship with a colleague isn't illegal. Most firms will allow some kind of consensual relationships. But if you're in the same reporting line and you can influence each other's pay, promotions, or deals, you are usually required to disclose it. And once you do that, typically what it means that one of you will have to move into a different division, or in some cases move firms. And in this case, this will be a major compliance red flag where you've got like a senior trader and the kind of chief investment officer of the firm, Harper, in a romantic relationship. So that would be a kind of major issue for compliance. And the investors would have a real issue with this because this means that there's a likelihood that some of the kind of basic decisions, as in what's happening here, where he's dictating an email which he doesn't think is a good idea, they would have a real issue with it. So any kind of hidden relationship where there is a kind of a reporting line or kind of power difference, that's typically a recipe for disaster. And it would normally kind of go against any kind of the fund prospectuses as well.
Well, hello.
Bizarre way to tell me you miss me.
Excuse me?
Your family office withdrew funds.
Lily Lara are pulling out.
I'm retired, Harper.
Dylan's the one that's across how we're invested. He didn't like your last few quarters. Said you're throwing sand in the air, and you're surprised it doesn't land as a castle.
So in this case, you've got Harper talking to Eric, and Eric is retired, and she mentions his family office. And I want to kind of explain what a family office actually means. So for very wealthy people, typically when they get into at least hundreds of millions of wealth, then they may not actually want to go to a private bank to manage their money because the private bank will just take tons of fees. So instead, what they can do is they can set up their own kind of captive investment firm where they'll employ the people, and those people, their main role will be to manage the money of the family. And that's what a family office is. So instead of kind of outsourcing that to a separate firm, they create their own firm. Now, in some cases, you have a number of families kind of cobble their wealth together and have one family office for multiple investors, or where one big investor sets up a family office and they maybe invite people, other families that they know, to leverage off some of the services because that will reduce the costs. There's no strict legal threshold, but if your wealth is below $100 million, it's going to be probably really expensive because the cost of setting up an office where you have a chief investment officer and you have the compliance and you have analysts, is probably going to be in the region of $6 million a year. And that means $6 million of an asset base of 100 million. That's way too expensive. You're just going to be destroying all your returns. So I would say probably it's more likely to be in the region of assets of at least $500 million, probably more than $750 million before a family office kind of makes sense for you, because it's just so difficult to justify the costs. Thanks for watching. We'll be diving into the next episode next week, so make sure you're subscribed and stay tuned for those reactions. See you soon.